1 second. All right. Top of the day to you all. Top of the day. And welcome to the Daily Mortgage Briefing from the Constructive House. I am your host, LT Fulton, mortgage advisor and the creator of the IPAC score, the proprietary home buyer readiness system developed by the Constructive House to give consumers a transparent, easy to understand assessment of their mortgage eligibility. And what the IPAC score does is it evaluates the four pillars that every lender uses to determine mortgage approval. That's income, property, assets, and of course, credit. And each day I like to break down what's going on in the market and how it affects real home buyers so you can use strategy, not stress, to determine your mortgage readiness. That's what we're about here at the Constructive House, is ensuring that you have the tools to equip and build a constructive household financially as well as other areas of activity. So let's go ahead and get your day informed and empowered. And the first thing I wanted to take a look at was the market snapshot, break down the interest rates for the day, what drives the interest rates. Then we'll get into the IPAC Spotlight, and I'll let you all on for the day. I'm not trying to take up too much of your time. But as for the market snapshot, let's take a look at what rates are doing. Hold on. Let me get myself together here. All right. So for today, the interest rates are stable with a slight positive bias. Most lenders are offering interest rates around 6.2 on a 30-year fixed. And FHA, all the government loans as far as FHA and VA are from a 5.8 to a 5.9%. Of course, that's dependent on your mortgage eligibility and your credit profile. And of course, the strength of your IPAC is going to determine what rate you qualify for. So always keep that in mind when you are looking at the rates each day, and they'll fluctuate throughout the day, but it still depends on your particular IPAC profile. That's why it is imperative that you get a copy of your IPAC score so you can be mortgage ready and know what to do and know that you have the tools that you need to be an informed buyer. All right, so as we always do here, because we like to simplify things, let's break down exactly what's driving the mortgage rates, because everybody loves to talk about rates, but not many people are talking about what drives interest rates. And that's why we're different here in a Constructive House. It's going to be these four indicators right here is what's driving the mortgage interest rates. It's the bond market, it's inflation, it's the Federal Reserve, and it's housing inventory. These four indicators are what drives the mortgage market rate, the interest rates. All the rates that everybody's asking you about, this advertising that you see all the banks advertising and all the different websites. These are the four indicators that determine that, if it's going up or going down. So we like to break it down so you can be an informed consumer, because it's all about simplifying the mortgage process. As I've said several times, and I'll never stop saying it, generational income and financial freedom starts with home ownership. For most Americans, the biggest investment you'll ever make is going to be buying a home. That's going to be your biggest investment. So it only makes sense for you to be equipped and have the tools you need to be able to be an informed consumer when you go out into the buying market, whether it's for your single family primary residence, whether you're doing investment home, vacation home, what have you. You want to make sure you have all the tools you'll need to be successful there. And if you stick with me and you follow, hit that subscribe button, share with your family members, you'll be equipped each day to know what's going on when it pertains to the bond market and how you can develop your own IPAC to be as strong as possible so you have resistance. No matter what this is doing over here, you're going to be good to go. Again, it's based on your income, property, assets, and credit. Go ahead to theconstructivehouse.com to get your IPAC score so you know where you stand. You know if you're ready to move forward or if you need some work. And that's where I can come in to help you out, myself or my team, and we'll give you the help you need. Again, it's free. It's free to get a score to find out where you're at for your home readiness. Why not figure it out? We're wrapping up 2025. Let's go ahead and get going today to see what we need to do for 2026. Let's go ahead and make that move and make that change. All right, so Going back to what's driving the interest rates, as it pertains to the bond market, mortgage-backed security prices have slightly increased today, which usually creates minimal positive impact on mortgage rates. Now, remember, when we're talking about the bond market, the mortgage-backed securities is what drives the bond market. And MBSs are like big boxes of mortgages that investors buy. If investors like the box, rates go down. If investors do not like the box, rates go up. And today, investors didn't love the box, but they didn't hate it either. There was just a mild interest in the mortgage-backed security boxes. And that's pretty typical at this time of year. We're in December, so you're not going to see a whole lot of movement traditionally. And right now it's showing that things are still typical. They're stable right now. We're still waiting on decisions from the Federal Reserve. We're still waiting on, what changes are going to happen in the market. And right now, with holiday season and all that going on, typically you don't see a lot of movement. So this makes sense. It's not nothing to be worried about when we're talking about the bond market. It's pretty mild right now. That's pretty common this time of year. Things are pretty mild. So for all of you all that's out there wondering, hey, what's going on with rates? What are the rates doing today? When are they coming down? Well, right now things are pretty stable, and that's typical this time of year. All right, as far as the other market mover, we got inflation. I did want to break that down real quick for you all, but when we're talking about inflation, right now we are in inflation nation. And keep in mind, the Fed's favorite way to measure how expensive everyday stuff is through inflation. Higher prices equal higher rates. We're talking about in your everyday stuff. Higher prices equal higher rates. Lower prices equal lower rates. And today, inflation pressures remain mixed like they were Friday when we went over this. So not hot enough to push rates up sharply, but not cool enough to drive a major drop in interest rates. That's where we're at when we're talking about inflation. Of course, PCE is that indicator that the Feds use for inflation. And we'll break that down as well. But that's what we're looking at on inflation as far as the market movers. Now, the head of the market movers is the Federal Reserve, the Fed. The Fed. And when it comes to the Fed, even one sentence from the Fed can shift lender pricing. And the Federal Reserve continues to emphasize a data-dependent stance this week. Remember, we talked about last week, they're just monitoring the market closely. They're monitoring inflation closely, and that's still what they're doing. So, of course, lenders and banks, they're waiting on pins and needles to see what's going to go on with that, what the Fed will eventually decide on doing, if they're going to make a move, if they're going to make some stance, some statement that's going to drive rates up or down. So, of course, lenders are holding on to see what the Fed's talking about there, to see if they need to go ahead and start making some move on prices. Now, our last indicator for the market movers is going to be housing inventory. So I wanted to break that down so you get an idea, because this is also what drives the market up and down. You know, when it comes to housing inventory, always keep in mind more homes that are for sale usually means less competition and more negotiating power. And this is the time of year where there's more negotiating power for the buyer. You know, schools in session. I know they're on break, but I mean, like, the school year is still going on. So not a lot of families are wanting to move during, the middle of the school year. It's also December, so it's a cooler month weather-wise. So not a lot of people are trying to move. So it's a buyer's market temporarily. So you have some more negotiating flex out there if you are looking to buy. And you're already in the process of buying, you have a little more flex. Make sure you're tapping in with your realtor. Make sure you're tapping in with your mortgage advisor, mortgage loan officer, and seeing what wiggle room you have. But as it pertains to the housing inventory is following the normal seasonal patterns, like I told y'all, and it's giving buyers a bit more breathing room. So you got a little more flex there. So not uncommon this time of year when we're talking about housing inventory. So always keep in mind that, hey, the more houses that are for sale, that usually means less competition. and more negotiating power. So keep that in mind. Housing inventory definitely matters. It definitely matters. All right. So next, I did want to kind of break down today's mortgage word of the day, mortgage phrase of the day, rather, which is PCE, personal consumption expenditures. And PCE is the Fed's favorite way to measure how expensive everyday stuff is. That's groceries, gas, clothes, all of it. And when PCE is high, rates usually go up. When PCE cools down, rates usually come down. So let's unpack that a bit, right? When interest rates usually go up, it is directly tied into inflation, which the measurement for that is the PCE index. All right, so this ties directly into your IPAC score because lenders get more cautious when inflation is high. So your financial picture matters even more. So keep that in mind. When inflation is high, lenders get more cautious. And that's why these indicators right here are so impactful. That's why I use this as our foundation daily, because it's going to tie directly into why you need a strong IPAC profile. And your IPAC, simply put, that's the areas that's needed in your mortgage application. That's what lenders use to determine your ability to repay a loan. What we do here is simplify things and ensure we are transparent with what's going on. And one of the key indicators here is inflation. All what the Fed's talking about, it all bases around inflation. That's what's going to move the needle on the bond market. That's what's going to move the needle on housing inventory. These all play a role in what your interest rates will be. And when you have a strong IPAC, you can come in there with some flex about what rate you want. When your DTI is solid, when your LTV is solid, that's in the property section. When your reserves is solid, that's the asset section. And when your credit is solid, you can go in there and start making some demands. And the way you will be equipped to know if you're able to do that is by following and subscribing. And of course, you want to share this with others because you don't want to keep me a secret, right? You want everybody to be able to win, I would hope. But breaking it down as far as the phrase of the day is PCE, personal consumption expenditure rate. That is what determines what inflation will be. That's what the Fed uses to go off of inflation. That is their tool. And when PCE is high, rates usually go up. When PCE cools down, rates usually come down. And this, like I said, this ties directly into your IPAC score. So you want to keep that in mind when you're making your plans, your financial plans to build your constructive house for 2026. You want to make sure that you understand your IPAC score needs to be as strong as possible so you can be resistant to this. So you can build your resistance for this. Now, what I wanted to jump into before we got any deeper into the IPAC Spotlight is what lenders actually care about. I wanted to break down what it is that lenders actually care about because that's very important. All right, that's very important. And when we're talking about getting approved for a mortgage, you need to know what it is that lenders care about. Of course, the IPAC. I know you've heard me mention it time and time again. But what lenders are looking for is your ability to repay the mortgage. That way they can lend the money to you. If they don't know if you have the ability to repay the mortgage, then they're not going to lend the money to you. So they need to know that you have the ability to repay it. And you need to know what they care about so you know where we're at. Now, that's the first thing. Now, as we're talking about income, we need to know that it's not just about the number on your paycheck. All right. What lenders care about is your stability. And that's what I wanted to discuss is income versus stability. All right. So two people can make the same exact salary, but get two different approvals. And the reason behind that is because lenders aren't just looking at how much money you make. They're looking at how consistent your income stream is. All right. So it's about consistency. They're looking for the stability. And one of the indicators lenders use for stability is if you have 2 or more years in that line of work, 2 or more years at that particular company. 2 or more years of you receiving that overtime you get, 2 or more years of you receiving that commission or that bonus. That's what they're looking at. And if you're self-employed, they're looking for 2 or more years of you receiving that income. Not a spike one year and then the next years are down. They want to see the stability. Again, it's about your ability to repay the loan. And they use that based on your stability. So it's not just on the income that you're making, not the number on your pay stub. It's not just about that. It's about how consistent that number is. The longer you've been on your job, the better. The longer you've been in your field. Let's say you have moved from job to job. This year you're working for this hospital. Next year you work for another hospital. But you've been an RN for 10 years and you've made X amount of dollars and it's going up, 10% every year. That's what they're looking for, that stability. They're not looking for somebody who one year you're RN, the next year you're a CPA, and the year after that you're owning a food truck. Like, that's not stability that they're looking for. They are unsure. They're undetermined if you'll have the ability to repay a 30-year mortgage, a 15-year mortgage, a 20-year mortgage, whichever one you're choosing. They want to ensure you have the ability to repay the loan. The bank does not want to buy the loan back. They don't want to foreclose on you. They lose money when they foreclose. So that's not what they want. So they're going to do all their due diligence up front. Whenever you hear the banker say, I'm submitting your loan to underwriting, that's them doing their due diligence to make sure you have the ability to repay the loan. And when it comes to the I in the IPAC, the income section, they're not just looking at the number on your paycheck. They're not just looking at the number that you say you make as a self-employed buyer. They're looking at the stability. They're looking at the consistency of that income. That's what they're looking at. So make sure that you understand what lenders care about when it comes to income. They care about your consistency and stability of that income you're making. So just 1 month you having a ton of overtime, but that's not typical of what you receive over the last 2 years. They're not going to factor that in. They're going to go off of what's typical. But if you do work 60 hours a week and you can show a 2-year history where you're working 60 plus hours a week, they're going to use that income. Again, that marker you want to know about is 2 years. They want to know if you've been on the job and in that line of work for 2 or more years. The more the better. It shows that stability. So keep that in mind. It's about the income stability, your income pattern. That matters more than the number next to your paycheck that says gross income, just because you got 10 hours more of overtime the last 90 days. But that's not something that's typical of what you make normally. Banks are not, lenders and banks, they're not really worried about that because they want to know your ability to repay the loan. So keep that in mind. So what some people have asked me, because I've done my fair share of mortgage applications, is, hey, why 2 people with the same salary get 2 different results? Well, the thing is, one buyer might have steady W-2 income with predictable hours. Another buyer might have variable income, overtime, bonuses, or they may even have self-employment income where they're chasing down contractors and vendors to make payments. Same salary on paper, totally different approval strength. Lenders approve patterns, not paychecks. So the applicant that has the steady W-2 income with predictable hours, and they've been on that job for 2+ years, the lender will show more favor. They have a stronger IPAC than someone who's self-employed and their income varies. Even though at the end of the year, y'all have the same income. One has a more stable, consistent income. Another has a variable and fluctuating income, even though you're making the same amount. The lenders are looking at the consistency, the stability, the overall pattern. And that's how you'll see 2 folks who may have a year-end income that's exactly the same, identical income, but this applicant's getting approved, this applicant's not getting approved. And the reason for that is lenders are looking at the income pattern. the stability of the income. That matters more than the number of the income. Keep that in mind. Always keep that in mind, because that's where some people get caught up and they feel that the banks have it out for them. They feel that the lender has it out for them, and that's not always the case. I mean, we broke down on the red line and case files that sometimes that is the case, but that's not always the case. Sometimes it's just that your stability of your income is not where it needs to be, and lenders do hold that against you, for lack of a better word. All right, so next I just wanted to go over, hold on. Next I did want to break down a couple more examples, and then we'll roll into the IPAC Spotlight. If you don't know already, we're going to be breaking down income. All right, but keep in mind that your mortgage approval is about pattern. Your approval is really a story about your last 2 years. Is your income trending up? Is your income stable? Do you switch jobs? Did your hours change? Lenders follow the pattern, and that's why understanding your IPAC score helps you predict your approval before you ever apply. Keep that in mind. Keep that in mind, because once you understand how lenders read your income pattern, you can shape your approval instead of guessing your approval. I talk to so many people who the first thing they tell me is, oh, before I sit down with you, LT, I got to find out what my credit is. I got to get my credit together, get my credit together. I've heard that for 2-3 years. Then they hit me up and they're like, I got my credit together. It's like, okay, and then we find out their DTI is too shot to be able to do anything. And it's like, I've been trying to tell you, man, hey, we got to work on more than your credit. Let's go ahead, let's go over your IPAC and see where we're at. So now they're even more discouraged because they took 3 years working on their credit and they didn't know that their income, their debt to income ratio is all out of whack. They just thought, hey, if I boost up my credit score, I'll be all good to go. And that's not how it works. That's why it's imperative that you follow, you subscribe, you stay tapped into the daily mortgage briefing, because I'm here to help you out so you don't run into that. So you don't waste years of your life chasing the wrong thing, fixing the wrong thing, only working on one thing, and there's other things you need to have your house be constructive. So without further ado, we're going to roll into the IPAC Spotlight. But one thing I wanted to leave you all with before we transition to the next portion is, if rates are rising, don't panic. If inventory, housing inventory is rising, you have more choices. If inflation stays high, lenders get cautious, so your IPAC matters even more. With today's earlier session of stability, buyers may see small pockets of opportunity to lock a favorable rate before volatility picks up. So keep that in mind. Before anything changes, right now is a good time to lock in a favorable rate if you're already in the process. All right, so next I did want to bring up just a quick math example to kind of make things a little more relative and relatable to the situation. But as it pertains to the income spotlight, a $200 drop in your monthly income can reduce your buying power by $20,000 to $25,000, depending on your other debt. Let me say that again, because some people are not aware of this. If you have a $200 drop in your monthly income, that can reduce your buying power by $20,000 to $25,000. Reduce your buying power. We're just talking about a $200 drop. A $200 drop. All right? So keep that in mind when we're talking about simplifying things with your mortgage. That's why having overtime where you made $200 more this month, but typically you don't see that type of overtime, that's why that can kill your approval when we're talking about the income portion of the IPAC. That's how that can kill that approval. Because that $200 being removed, that reduces your buying power. And remember, it's about ownership. We're here to preach ownership. So you don't want to lose $20,000 to $25,000 of ownership. We want to make sure you can get as much ownership as you can out of that. All right. So as we go into the spotlight for IPAC, we're going to be going over and unpacking income. And lenders don't just look at how much money you make. They look at how consistent it is, like we've been discussing. They're going to look at how consistent your income is, right? So with some of the examples we've already used, I just want to break down that I had a client who had great money, but had to switch jobs twice in a year. Once they understood how lenders are looking for stability, not perfection, we had to structure their file correctly, and their approval changed completely. I think I went over an example before about a nurse, and I can use that same example because they change jobs twice in a year as well. But it's about stability, because we got to the point of conditional approval. We did a WVOE. We did a verbal VOE. And we did a WVOE, a written verification of employment, that you send off to the underwriter, not to the underwriters, that you send off to HR, and HR will respond back. And if this is the income they get, how long they've been there, et cetera, et cetera. They break down, their verification of employment. And come to find out, they only have been at that job 6 months, even though they had told me they've been there for 2 years. And come to find out, they only have been there 6 months. And their income wasn't exactly what they told me, but nonetheless, the income checked out. But we didn't have this. We didn't have a 2-year history. Went back, looked at it. Of course, we had to get a verification on the previous employment to make sure there was stability, that they were still making that same amount of money. Because once that first came in, that they only have been there 6 months, of course, they're going to get a crazy email that says their loan's been suspended due to income stability. So they're like, hey, what's going on? I need to buy this house. I'm trying to move. Kids got to go to school, et cetera, et cetera. I got this new job. I got to get closer. And they're saying it's suspended. What's the problem? What's going on, LT? And I'm like, hey, we need stability of income, not just the amount. And they're like, oh, I make enough money. Why can't I get the house? It's like, hold on, just relax. Lenders are looking at, and in this case, I'm looking at your stability of income. Yeah, you sent the pay stubs that show you make the money you make. Yeah, the verification of employment showed you make the money you make. But the stability of income doesn't show that. It shows you've only been here for 6 months. What have you been doing the last 18 months? Oh, well, I was a nurse somewhere else. Okay, well, where else were you a nurse at? Let's get this in. Let's get this in. All right, we input it. Now I got to get verification of employment from that hospital, from that doctor's office, and find out how much it was that you actually made to make sure you have the stability, and that it wasn't just some crazy shift where you jumped on a higher paying role, but that's not consistent with what you typically get. And that's where a deeper dive comes in, to make sure, of course, you're not a contractor, you're full-time. All that's broken down in the verification of employment. But nonetheless, once I explained it, once I let her know that this isn't the end of the road, that's just a automated email that goes out, we restructured it. Everything ended up being A-okay. I've had some situations that weren't A-okay because of this, because of lack of stability, and because of clients not being upfront, because they're not familiar with why the IPAC is important. They just know, hey, I made this kind of money, I should be able to get a house. I work real hard, I should be able to get a house because I work hard. Not knowing that, hey, you got somebody who's going to lend you X amount of hundreds of thousands of dollars. They're going to lend you that money. And you think they should just give you $500,000 to buy a house because you work hard. They got to make sure you're going to pay them back. They're not, hey, banks and lenders are not charity organizations. They're not charity organizations. So they're not just going to give you money because you work real hard. It's not how that works. That's not how that works. So they're going to evaluate your income, property, assets, and credit. And for today's spotlight, we're going on income. They want to make sure you have stability. They want to make sure your pattern of income is stable. Not just I get paid here and there. Or not just I worked overtime this 1 month or this 1 quarter and I got a lot of money, so let me go ahead and buy a house. No, it's not how that works. It'll never work that way. All right, so as far as some do's and don'ts, make sure that you do file your upcoming taxes, especially if you want to make sure you got a strong IPAC. Get together with your CPA. Let them know, hey, I want to make sure that my IPAC is strong as possible. So what do we need to do when it comes to filing my taxes to make sure that it is as strong as possible? I want to make sure I'm home ready. Let them know I want to be home ready, especially if you're self-employed. Let them know I want to be home ready. Let them know that. As far as anybody who is W-2, make sure that you are keeping your W-2s. I know they'll be coming in January. Keep your W-2s, save it on a thumb drive, save it on your computer or your phone. But like I said, always save it in the cloud and your thumb drive, because if anything happens, you want to make sure you have it in multiple areas. Keep up with your pay stubs and W-2s. Do not switch jobs during the mortgage process. So anybody who's doing a loan application right now, anybody who's planning on doing it, do not switch jobs midway through the loan process. Do not do it. It can kill your approval. It can kill your approval, because remember what we discussed. Income stability patterns. It's about your pattern. So you don't want to put yourself in a position where you're killing your approval. That's not something you want to do. All right, so keep that in mind, right? Now, I'm going to give you another action step. I want you all to take 60 seconds to look at your last 2 months of income. All right, go over all your pay stubs over the last 2 months. That's 60 days worth of pay stubs. For my self-employed folks, go over your profit and loss over the last couple of months. All right. Take note of anything that's changed. New job, bonus, overtime, commission. Make note of that. This will help tell a clean story to the lender. And do that every couple of months. Make note of it. Because if the lender needs a story told, they're going to reach out to you and say, hey, we need you to write a letter of explanation on this income. And you'll already have it. And you can just shoot this over to them. You'll already be set. If you've had any changes in income, changes of employment, changes of commissions, just make a simple note of that. And the way technology is today, you can literally, hey, income changed on April 16th, 2025. And that's it. There's no reason for the biggest investment of your entire life for you not to take 60 seconds to be equipped with the tools needed to be an informed buyer. There's no reason to not do that. No reason. So don't do that. Don't do that. All right. Make sure you're on top of your game. So, like I said, I wouldn't be before you long. If you want to know how your IPAC stacks up today, take the free IPAC score at theconstructivehouse.com. And thank you all for joining today's daily mortgage briefing. Remember, you don't need perfect circumstances to buy a home. You need a strong IPAC strategy and the right information. If you want help reviewing your IPAC score or planning approval, the links are in the description below. Have a constructive day. Thank y'all all for tapping in.